Okay, so let's talk about some different terms here. I've kind of thrown out some terminology that might not be familiar to you. So let's talk a little bit about that. Now, first off, we're going to go back to this concept of basis. We talked about that last chapter when we calculated our depreciation. The concept of basis comes into play when we're calculating gains and losses as well. And we need to know what the basis is of a property in order to calculate any gain or loss that we have when we dispose of that property. So remember, all of the costs associated with putting an asset into service are going to be added to the basis. Those are items that get added to that base. So, you know, we buy a piece of equipment for $10,000, and we have to have it shipped, and that cost us $1,000. And we've got sales tax, which was $700, and we had to pay somebody to install it, and that was $500. And then we had to do some testing on it to make sure it was running properly and doing what we needed it to do, and that was another $500. So our basis in this property is the sum of all of those. So what do we have here? 12,700 is our basis in that property. And that, of course, is what we're going to use to depreciate the property. Now, depreciation, all of these items have added to the basis, adjusted the basis from its original basis. Remember, depreciation also adjusts the basis. It adjusts it downward. So if we've depreciated it, say we've had it for 2 years, so year one depreciation was $1,000. And year two was, let's make it easy, $1,700. Now our adjusted basis is $10,000. That's what it's on our book for. Kind of the same as financial accounting, except we don't have that salvage value involved in it. Now, what happens if we sell this piece of equipment? We sell it in year 3, and we sell it for $11,000. Somehow this piece of equipment has appreciated in value. Well, our adjusted basis was $10,000. We're selling it for $11,000. We're going to subtract that adjusted basis. And we have a gain now of $1,000 that we have to pay tax on. Okay? What we used this for is going to determine how it's taxed. Not necessarily the nature of the equipment, but how it was used. Okay? But this is what we're concerned with in this chapter, is how do we tax this? Knowing what we used it for, knowing what its purpose was. If it was an investment, it's going to get taxed differently than if it was a piece of equipment that we used in our business. It's going to get taxed differently if it was, instead of equipment, let's say it was inventory that we had. We had a whole pile of inventory that we had purchased, and we sold a bulk of it to maybe another company, right? So that they could try and sell it. Well, that's going to get taxed differently as well. So we're going to go through all of that. But this concept of adjusted basis is really important, as well as our sale price and gain and all of that stuff. So they give an example here of a copy. I'm not going to go through that. It's kind of similar to this. So sometimes, as they mention here, sometimes the basis is something other than the cost of the asset. So we talked about different ways that we can receive assets. We can inherit them. We could be gifted an asset. We could exchange it for some other asset. So it might not necessarily be what the actual cash that was exchanged if there wasn't any cash exchanged for it. So if the taxpayer receives investment property in exchange for services, okay, now we are not actually getting money. We have given our services to another entity. So for example, let's see if I can think of an example off the top of my head here. Okay, I'm an accountant, and I did some work for your business, and instead of you actually paying me for my services, you give me some stock in your business instead. Okay, now I didn't get cash for it, I got some stock instead. The basis is going to be the fair market value of the property that was received. Okay, so if that stock was worth, maybe I got 100 shares of stock and they were worth $100 a piece, so $10,000, that's going to be the basis in that property that I received, in that stock that I received. Okay. If the value of the services was known beforehand, though, let's just say in the first scenario, I didn't know what the value of my services was. I don't know what I would charge for that work. But if I know what the value of my services are, so let's say I'm a CPA, I know I put in 100 hours worth of work and I charge $100 an hour, so the value was $10,000. Then the asset that I'm receiving, those shares of stock, are worth $10,000. So it's kind of the same in both scenarios in the example that I used there. If assets are transferred by inheritance, so grandma dies and leaves you her house. Grandma's had that house since 1972 and she paid $3,000 for it. That house is now worth $700,000. She owned it all that time and now it's worth $700,000. The basis of that asset, because you inherited it, is not the $3,000 that grandma paid for it. The basis is the $700,000, the fair market value on the date that she died. That is a great tax benefit of inheriting assets, because essentially what it did was we avoided any tax on the $697,000 of gain that we had on that property. So I'll write that down, see if it makes a little bit more sense. So grandma bought it, the house, 1972, and she paid $3,000 for it. In 2023, you inherited it, and it was worth, the fair market value was $700,000. You're going to use that property, maybe you're going to use it in a business, maybe it's going to be an investment property. It doesn't really matter. Your basis in that property is now $700,000. If grandma had sold that house before she died for $700,000, grandma would have a gain of $697,000 that she would now have to pay tax on, depending upon the type of property it was. If it was her personal residence, well, she still would have to pay some tax on it. But because you inherited it after she passed away, now it gets what's called a step up in basis. Well, it's step up basis. Okay, you get to step that up, so thus avoiding paying tax on that gain. It's a pretty sweet deal. Grandma wants to give you some property that's appreciated and she wants to give it to you before she dies. You might tell her, let's just put that in your will for me, okay? So that's for inheritance. So it's the fair market value on the date of the individual's death. There is an alternative valuation date, but it has to be affirmatively chosen by the representative of the estate, okay? If that asset is transferred by gift, so instead of grandma leaving that to you in her will, she gifts you the property. Now your basis is her basis. which is the $3,000. Which means if you turn around and sell it now, you're gonna have a gain of $697,000. Okay, so you can see the benefit of waiting until after somebody has passed away to transfer assets that have a lot of appreciation in them. Okay, so again, it depends upon how the asset was acquired. This is just kind of some of the definitions that we'll go through. So let's see, what do they say here? Again, basis is a starting point. We talked about that. So sometimes you acquire an asset as well that has some debt attached to it. So you buy a building that has let's say you buy a $100,000 building. And the person who owns it still has a mortgage on it, and you agree to pay the mortgage. So you pay them $100,000 in cash, whoops, 0, plus you assume a $20,000 mortgage. So now you're going to be responsible for that mortgage. You're going to have to pay it. We get to add that $20,000 to our basis because we're going to have to pay it. It's our responsibility now, right? So this becomes our basis in that property. If you purchase a property and you take out a mortgage on it, again, your basis is the full value of the property because you are responsible for that mortgage. So another example, if we bought a building that was $120,000 and we put only $20,000 down, and so we owed $100,000, where our basis in that building is the full $120,000. Okay, so it's not just the amount of cash that we pay; it's also any debt obligations that we assume in that exchange. Or if other property is exchanged as well, the fair market value of that property is also included in the calculation of that basis. So we could buy it, we could inherit it, we could be given it as a gift. If it's through a divorce, the fair market value is going to be whatever your fair market value was. That doesn't change the fair market value of it for basis purposes. So for example, if you have a $300,000 house and you receive the house in the divorce, it's still a $300,000 house. It doesn't change the nature of it. And then exchanges, for the most part, is going to be whatever the fair market value is of the item that you receive. Now, we have increases and decreases in the cost of basis to get to our adjusted basis. We talked about, so types of decreases are 179 deductions, depreciation. There are some other ones as well that are a little bit more obscure, but our main ones for our purposes, that 179 deduction, bonus depreciation, anything where we received a tax benefit from depreciating that item or reducing the basis of that item. Increases, so if we improve an item. They've got some examples here, a room addition to a home. So we have a rental property, let's say we paid $100,000 for it, and we decide to expand the kitchen on that property, and we paid $30,000 for it. Well, now we've just increased the basis, we've adjusted that basis by that $30,000 cost, right? Now these are kind of obscure too. The cost of defending or perfecting title to a property or patent, commission fees for purchasing stock and stock dividends received through dividend reinvestment plans. Those, we'll talk about that a little bit more at the end of the chapter when we talk more about stock. Okay, so when we talk about gains and losses, we need to look at the difference between recognized gains and realized gains. Something is realized when it happens. but it's not recognized until we have to pay some sort of tax on it. So the amount realized from a sale or trade of property would be everything that you receive in that transaction. So for example, well, let's say we sold a house for $100,000 and we received $100,000 cash for it. We got $100,000, we realized $100,000. Now, the amount recognized though is the amount that we're actually going to be paying tax on. And in order to calculate that, we're going to subtract our adjusted basis from it, right? So cash, so this is realized. And if we have a adjusted basis of 50,000, our recognized gain is the $50,000. Okay, so that's the amount we recognize. Generally speaking, a recognition, you can think of it as, what are we gonna pay tax on? What is it that the IRS wants us to pay tax on? Gains and losses. I'm not sure that this is really helpful, but I don't know, greater than, less than signs always confuse me. How about anybody else? But, so if the amount that we realize, is less than our basis, so let's look at an example of that. So here's our house, we've got an adjusted basis of 100,000. If we got 40,000 for it, realized, our basis is 50,000, then we have a loss, right? We have some sort of, we have a loss, and maybe a capital loss, it may be a 1250 loss, it may be a 1245 loss, it all depends on what type of asset it is. And I don't expect you to recognize what those terms mean. I'm just saying it could be different depending upon how we use that asset. If, however, in this case, the amount realized is greater than our adjusted basis, then we have a gain, right? Let's see. If there's anything else I want to mention here. So the recognize is the amount that will be recorded on the tax return as a gain or loss. You guys pretty much, you understand gains and losses. You did this in financial accounting. But we'll go through a couple of these examples here because we've also got some added intricacies here with some liabilities that were released, because anytime a liability is released, so you no longer have to pay it, it's as though you got the cash, right? So in our example, when we bought that building, that $100,000 building, and we assumed a $20,000 mortgage on it, that meant that our basis was $120,000. Well, if we're the seller of that, we got the $100,000, but also we now don't have to pay the $20,000. So we realized $120,000 from that sale, even though we only got $100,000. Does that make sense? Because we get the benefit of not having to pay that debt now, right? So it's $20,000 that we're not going to have to pay in the future. We're $20,000 richer, right? So here we've got Indra sold a parcel of land for $55,000 of cash. The buyer also assumed a $15,000 note attached to the land. She had originally purchased the land for $34,000. It's land, so its basis isn't going to change, right? Unless you buy more land or sell some of that land. So her basis was $34,000. The gain on the land is going to be $36,000, and what we would do is add together the cash that she received plus the liabilities that she no longer has to pay, that she's released from. So $70,000 minus the basis of $34,000. to get her gain on the land. Okay, again, we don't know what she used that land for, so we don't know, this is just the calculation of the gain or loss. We'll get to how that gain or loss is treated depending upon how we used it, okay? Now we've got Larry. So Larry needed cash. He sold a parcel of land for $55,000. The buyer also assumed a $15,000 note attached to the land. So again, $70,000 total. But he originally purchased it for $72,000. So now his basis is $72,000. What he's receiving is $70,000. He now has a loss on that land of $2,000. That $2,000 loss, again, is going to be reported on the tax return, and how we treat it is going to be dependent upon what Larry did with that land. Whether it was part of a business, whether it was personal, whether it was whether it was an investment, whether it was just personal property, not personal property because it's real estate, but whether it was none of the above, if it was just something that he owned. Okay? Again, the nature of how we report those gains and losses depends mainly on the use of an asset rather than on what the asset is. Okay? Land can be used in a business. Land can be part of your personal residence. Land can be an investment. And the sale of that land in each of those three different scenarios is different, right? In each of those sale examples, the tax treatment is going to be different. The land doesn't change, it's the same land, but how we used it makes a difference in how we report it. So we use this, we'll take a look at the Schedule D here in just a second. And that's why, so they talk about those differences there. Questions?